So in this lesson, you're going to learn about diagonal liquidity. So to understand this concept, you need to understand how retail traders trade. And one of the oldest retail strategy is trend lines. So this is how retail traders look at the market. So first thing, they identify the macro trend, which as you can see here is bearish. Prices making lower lows and lower highs, lower lows and lower highs. So now they would draw their trend line. They would look at where price is making the most resistance to form their wedge. And now what they would wait for here is they would wait for price to break out of these ranges. So if price breaks out here, they would take a long position here. And if price breaks out here, they would take a short position right here. So how can we use this information and reverse engineer how retail traders trade for a better probability? Let's say you have a bearish trend. Now, let's say you want to trade a continuation. You would be trading to continue the trend bearish. Let's say you're waiting for a breakout for a trend to change. You are trending bullish, trading bullish. So now what a retail trader would do is they would mark their trend lines. Since they know the price is trading in a channel, and you understand that they're waiting for a breakout either here or here. So now how can we take advantage of this? What we can do is wait for price to break out and come back inside of the range. Once that happens, you have a diagonal purge, where this would be your purge, your liquidity sweep. And from here, once price comes back inside the range, you can trade all the way from here back down to the extreme. And what you can always do is you could pull out your fib and trade to the extreme, which would be up to here. So you have the free reign from here all the way to here. And you can even take price all the way back down to your diagonal extreme. Before you proceed, make sure you like the video, subscribe to the channel, and please leave a comment. Let me know how you guys feel about this current lesson. So as far as looking for your trap, what I found works in current market conditions is you wouldn't confirm your fake trend until you have 3 taps. So you need a tap and a significant pullback. The significant pullback is really important. So you need a tap, significant pullback. Now you need a tap and a significant pullback. So when price does come up here, this is a convincing enough trend line for the retail trader. So when price does come up here and comes back inside the range, this is a valid diagonal purge. So now you're trying to take price all the way back down here, or like we said previously, to the extreme of your regular range. So let's take a look at this example. As you can see here, you have your 3 taps. Let's zoom in. So as you can see here, you have your 3 taps where you have a rejection and a pullback. You have a rejection and a significant pullback. And then you have a rejection and a significant pullback. So what are we waiting for? We are waiting for price to break out of this range. And I know your question would be, what time frame? So as far as your illusion trend lines here, your retail trend lines, they should be where the reaction is a wick. So a reaction from your support and resistance should be a wick. As you can see, you have a wick here, you have a wick here, you have a wick here, and so on, so on. So all these rejections are wick. And since they're wicks, obviously the concept of price, if you go on a higher time frame, these rejections will still be wicks. But if you go lower, so let's say previously we were on the 4 hour, this is the lowest we can go where our rejections are wicks. Look what happens when we go lower. So when we go on the 1 hour, you'll start seeing body closes below. That means the price spent too much time down here for this time frame. So as you can see, there is a candle close. And look what happens when you go even lower. So let's go into 30 minutes and you can see there is more inefficiency. So we have a body close outside of the range and back inside of the range here. And that's why we will stick with our 4 hour, because this is the lowest we can go without compromising our wick rejection. And this is what works currently in the current price action. As you know, price action changes. This is not the same price action that was delivering in 2021, 2020. Price delivery did change. So now we confirmed why we're using the 4 hour. So what we're waiting for is a close above. So we're waiting for price to close above this range and either come back in and close below, or we would look for a significant shelf and trade the breakout. So we have a body close above. So what are we waiting for now? So now that we have our body close, what are we waiting for? We are either waiting for price to close below. So let's say price closes below. And once price closes below, we can take a trade back to the extreme, or you would wait for this shelf. As you can see, you have a shelf right here. And once price gets below this shelf, you can take a short right here. And where would your TP be? Your TP would be at the extreme. So you would pull out your fib and your TP would be at the extreme. Let's see. Price did not close back below. But now if price does come up here, like we said, our entry is right here. Our entry is right here and our TP is right here. So your entry would be here. And your first TP would be right here. And of course, you can always hold the trade all the way until the end of the diagonal range. But our first TP would be right here. So let's say it's not a trend line and it's a wedge. What are you going to do? Here you have your wedge. So what are you going to do here? Well, the same concepts apply. So you would look for the exact same thing as you would look for if it was a channel. You would look for a breakout, a close back in, or a break beneath a shelf. So here's our example. As you can see, you have a rejection, drop, rejection, drop, and another rejection, drop. Same thing goes inverted. So what are you waiting for now? Exactly the same thing. You're waiting for your fake out. You're waiting for your liquidity grab. So now when price comes back inside the range, all we got to do is locate our shelf, which in this case would be here. This would be our shelf. Price was held below this level, above this level. So when price does come back inside of the range, you're waiting to take a trade here, all the way down to your obvious first TP, which would be right here. And your second TP could always be the bottom of your wedge. Hope you guys enjoyed this lesson. Make sure you like, share, and subscribe, but make sure you use code ETMARMY for 25% off everything on the website.